understanding volatilities and the factors that we have to bear in mind when it comes to volatility. So let's get started. First things first, please read the disclaimer below. Once read, please continue with the video. I'm hoping that you guys have read the disclaimer by now, so let's get started. So as I was mentioned before, we're going to be talking about understanding volatility. So volatility in Forex, it basically refers to, how volatile a currency pair is and how much it's moved, and it's usually measured by, different things like frequency and all that, and the way, the price has been, going about past couple of days, weeks, etc. So it's again, the importance of this is so that we know, what type of pair we're trading, what are the risks associated with this pair, and in terms of the higher the volatile, the riskier the pair, as you know. So sometimes volatility can be good, whereas it makes a stock move a lot. On the other hand, it could work against us as well. So it's really important that we understand how everything works. And for volatility, we need to know, how volatile a stock is. For instance, let's just say Euro USD moves around, for example, 100 pips a day, whereas GJ would more move like 400, 500, 300, 600, etc. So you could say that GJ is more volatile compared to EU, the Euro USD, and hence why whether there's high opportunity for you to make these gains, it's also a lot more riskier. You need to place bigger stop losses. You also need to, it could stop you out because there's so much movement. And then, on the other hand, it could work for you as well, because if the more it moves, the greater your profit can be, and you can catch more pips. But we need to understand how it works and how we can measure volatility, and basically, how we can use that to benefit our trading. So there's mainly two types of volatility. The first one is the historical volatility, as I was mentioning earlier. This refers to the price movement a currency has done over the past couple of days, weeks, etc. It all depends on the type of trader we are. If we're short-term traders, then we'll be looking at days and hours mainly to see how much a stock usually moves, and based on that we can anticipate that, look, Euro USD moves about 1,000 pips, so we can 100 pips. Sorry, my apologies. So it moves about 100 pips, and then we can anticipate that we can expect around the same type of movement, or a little bit higher, a little bit low, but somewhere around that mark, based on the historical plus close days that we've had, based on the historical movement it's done. So we can use that data to benefit our trading, and to use that on our probable side of things, in order to ensure that we're on the right side of the pair. And also we can use that data for our stop losses, and we can use that data for risk to reward. We can also use that data for our take profits as well, because if we know the euro is only going to be like 80 to 100 pips a day, we're not going to have a take profit for 400 or 500 pips, because that's unrealistic. And then we'll be basically waiting for days for possibly a TP to be hit, or 9 times out of 10 it'll just come back and it'll stop your break even or hit your stop loss, depending on the way you're managing the trade. So it's really important. Whereas on the other hand, let's just say we've got GJ moves a lot, then we can aim for a higher risk to reward. So we can aim for like 1 for 5, 1 for 4, depending on the type of trader you are, the way you trade things, and everything else. And based on that, you can obviously set your take profits and set your stop loss levels. On the other hand, we've also got the implied volatility. This basically refers to the market's expectation of the future price movement. For example, we can say that euros, there's something good that's really happening in Europe, and then for instance, like they've had a really good the inflation is going down, and there's more like economies boosting and stuff like that. So we can basically use that as a fundamental type of thing to anticipate that euro is going to get stronger. Or let's just say there's a trade deal between euro and another country, and based on that, it's going to affect euro's GDP, and so overall it's going to affect the economy as well, which is going to be, of course, positive for euro, meaning that implied volatility in terms of that we can expect, or we can calculate, or we can basically anticipate that there's this volatility on euro. It might go a little bit higher, we're expecting that the euro is going to get traded more because there's good things going on about it, and then we can trade the pair on these bases as well. But it all depends on the type of trader you are and the way you go about and look at things. So it's really important that you understand everything when you get into trading, and it's also really important that you have your own plan and have your own strategies and have your own risk parameters, as well as take profit goals that for some people have. For example, some people would say that we would like to catch X amount of pips per week after all losses, in order for them to survive, in order for them to make a business out of trading, and then based on that they can just expect the same from euro as well. So this is really important that we know how everything works. Next thing is measuring and comparing volatility. Now a lot of people must be thinking, how do we measure volatility? And it's something that's quite complex. It's something that's not straightforward. So I'll be showing you various ways that you can use to measure volatility, and based on that you can basically it can help you measure volatility, and based on that you can be on the right side of the market, hopefully. So let's just say that first things first is you can do it in different ways. In essence, it represents to different trading variations and etc. And it also depends on the time as well, and it also depends on whether we needed to use any indicators to do that, which I'll be going into now. So you can compare volatility in loads of different ways. First thing first, that I like to use is ATR. It's an average true range indicator. It's available on TradingView. You can also get it on MetaTrader 4, I believe, but I just use it on TradingView, and it's really good because it basically, what it does is you can select it calculates how volatile a pair has been. It tells you the average movement, and based on that you can expect your stop losses and take profit on the pair to move a certain way. Let's just say it's compared the past 14 days data for Euro USD, and the Euro USD has been moving 80 to 90 pips every day, meaning that we can expect that sort of movement, and every hour we can expect like 100 and something, for example 150. Now based on that we know that the Euro is going to move 150. We're getting into a trade, so our stop loss needs to be greater than 150 in order for let's just say for our trade to last, and then we can have a stop loss, for instance, for about 20 pips or 25 pips, or even 20 should mostly do it, but I'm just giving the example for example purposes. So this is not that you have to do it, but I'm just giving the examples just to make things clear for you guys. So let's just say we put a stop loss of 20 pips. Now the Euro's got an ATR for now of about 150. That means that if you need to get 1 to 3 years to road, we're going to anticipate that based on the volatility of this pair, it's going to take us around 3 hours for it to hit around 450 pips, which is almost 1 to 2 point something risk to reward, meaning that that's what we can expect from Euro. Whereas for other pairs, depending on GU, GJ, etc., ATR will help you identify how much they've moved in a certain particular whatever time frame you're on. So if you're on 1 hour, 4 hour, depending on what you're trading, 15 minutes, it'll tell you that the average for past 14 days, and you can use that to compare the volatility for that pair. There's also other things like standard deviation. Standard deviation is quite simple, and it's another method that we can use to measure volatility. It's like a lot of people like to use this because it's like a calculation where you can just use it quantifies what's happened in the past few days, and you can just use that to compare the volatility for each session. And you can also use that for just to get an idea of how it appreciates, how it depreciates, what type of movement we can expect. So basically it can help in that much way. It can help in so many ways as well. There's also things like the Bollinger Bands. I've also made a video on this Bollinger Bands previously as well. It's quite simply it's just bands that are created by John Bellinger, I believe, and there's a band on top and there's bands on the bottom, and when it gets into the bands you'll be able to see how basically it's like there's oversold and overbought bands, and then when the volatility is low, the width will usually it gets bigger, and the volatility is high, it gets smaller. So it's just it's something that you'll have to look into, Bollinger Bands. I've got a video on that as well, a detailed one, which you can use. But if you do have any more questions, please leave in the comments below, and I'll be happy to answer as well. Now there's also volatility indexes. Some people like to use these because obviously they help in a lot of ways. I've used them previously as well, and they do help, and it all depends on how you basically take this information. So when comparing volatility, keep in mind that higher the volatility doesn't mean that you're going to get a better trading opportunities. It just means that basically it can be a higher risk as well. So it works both ways. This volatility and these volatility indexes, they're available on different trading platforms like the MetaTrader 4. They're also available on TradingView as well. So this was something that you're gonna have to plug and play to see which one works the best for you, because there's loads of different types, and each to their own. They're good in their own ways. So it shows you it's crucial to consider the spreads as well, because when you trade in different sessions, for example, like the overlap between London and New York, the spreads will be a lot lower. So volatility indexes will be able to show you, that you can combine this information. They'll be able to show you how volatile a particular thing is. You can also use things like the volume indicator, which I'll be making a video on that as well, so you can have a look at it for future purposes. But these are some ways that we can measure volatility. Again, now, what affects volatility? Not a lot of people must be thinking, why is it so volatile? What affects volatility? What is it that changes everything for volatility? So let me get into that now for you. So let's just say, it's affected by various factors. Some of them, they're fundamental factors, such as the news events, the CPI, etc. There's things like the economic events, for example, like the GDP, employment, sales, inflation rates, so on and so forth, central banks' decisions on interest rates, monetary policies. There's loads of different things, and then these can have an immediate as well as a major impact on volatility, because during this time you'll see the volatility is really high. There's also things like the political events, for example, like elections, or there's a problem with the government, or there's a country's currency values going down, and there's political events going on like the riots, etc. So this can have an impact as well. There's also things like the market sentiment. Market sentiment is basically, it's just like, it tells you, whether there's a long percentage and short percentage, and what, if the market percentage believe a currency will strengthen, there'll be more buyers, and also if they believe it's going to be weak, then there'll be more sellers to push it down a little bit. And obviously we've covered that in previous videos. There's also things like the speculations. A lot of traders like to speculate things. For example, let's just say we've got a really good news for Germany, for instance, or France or whatever, and they're speculating that the car manufacturing market is going to increase by 2%. Now this could possibly have a major impact on euro, because obviously it's good for Europe that their car manufacturing and their car export and export is increasing, meaning that their GDP will be affected, hence why we can speculate the euro is going to get stronger. There's also things like the natural disasters or the global pandemic. As you know, pandemic was a really tough time for everyone. A lot of countries were struggling in so many ways. The town centres, everything was pretty much shut. Again, the stock prices, that they literally, some stock prices were increases, some stock prices like the airlines, and everything else, they took a huge blow. The oil wasn't doing so well. The gold was doing okay because it's classed as a safe haven. Some countries like the GU, like GPUSD, the EURUSD, a lot of the countries, they had major tough time. The stock market was pretty much, it was going all over the place, which was quite dangerous time for you to trade, because the volatility was increased, meaning there's a great chance of you either winning or losing, and 90% of the traders usually lose. So you can anticipate, or you can for you to be on the other 10%, you'll have to be really good at what you do, and you'll have to be really strong at what you do. You'll have to know what you're doing. You'll have to have proper parameters, proper plan, and again, implement that onto your trading. There's also things like the releases of key economic reports. Now, these are quite similar to the first ones, which are the economic events, and how they work is obviously there's reports like the monetary policy, and there's other reports by showing supporting data from different things like the health, the inflation. There's also things like the education side, and so on and so forth, and these can have an impact on the volatility as well. But again, understanding these factors, they can only increase your probability. They can't guarantee anything, so we need to use our proper risk management, and we need to know what we're doing when it comes to volatility as well. Now, the pros and cons of volatility. The pros include, like, obviously there's trading opportunities. You might find that the high volatility leads to a large functional trading opportunities. The price will move more, meaning that you might be able to catch more pips. On the other side, there's increased volume as well, so more people will be trading because the stock's more volatile. They'll think that they'll make great returns, but it's not always guaranteed. There's also, like I was saying, potential for high returns. Again, it's not guaranteed, but then you can anticipate that if a stock moves more, you can make more if you're on the right side of the things. Now, the cons for this are, again, there's pros and there's cons. The con is that there's increased risk because it moves more. The chance of your stop loss getting hit is stronger. It might not do so well as you expected, and it'll just it's just going to take you out of the position because it moves a lot more, and your stop loss may be too small. There's also uncertainty as well. Uncertainty is a big one because obviously, let's just say high volatility during a period of uncertainty, for example, like the economic events. It could, or if a country's in a problem with their inflation, if a country's in a problem with their interest rates. For example, in the UK, the interest rates are really high. There's a lot of uncertainty. No one knows what the housing market is going to do next as well. No one knows. The cost of borrowing has gone up, meaning the cost of inflation has gone up, and the wages are not gone up at the same rate. So there's uncertainty, and then they can reach things like the recessions, which can obviously have an impact on trading as well. There's also things like it could be stressful, hugely stressful, if you're on the wrong side of things and you've made losses and now you're stressed and you're thinking that you've lost out too much and you lose hope. But then again, that's where your psychology will need to support you, and you need to know that what you're doing and how you go about things. When you're winning, you don't get too excited. When you're losing, you don't get too emotional. So that's something that I'll be doing a video on psychology as well, just to help you guys, because this is something that a lot of traders struggle with on a daily basis. It's a really tough one because we all take emotional decisions differently. We all react to things differently. We all react to wins and losses differently. So it's mainly on your individual basis how you do things and how you go about things. But not to worry. Obviously, trading is a marathon. So it takes time. You can't really run to the finish line and you'll have all the profits. Unfortunately, it doesn't work like that. So you'll have to put a lot of hard work, like you do in every other exam or every other education or every other thing that you do. For instance, it could be sport like boxing, or it could be things like football or everything else. So you'll have to put the hard work. Practice makes perfect. Again, now we get to the conclusion that now, in this one, I'd like to again say that you'll have to use proper risk management, because without risk management, you'll be losing a lot of money, and you could blow your account and you could lose out your capital quite quickly. So you need to know what you're losing, what you're winning, and have a proper trading plan and discipline in place. Again, practice makes perfect. The more you learn, the more you practice, the better you'll get. So thank you so much, guys, for watching this video. I hope to see you in the next one. And if you have any questions or if you have any suggestions for future video, please leave them in the comments below. We're on social media as well, so you can follow our pages on Instagram, Twitter, and Facebook, and also subscribe to this channel for more future content. Thank you.